Hi, today we welcome Jessica Bemer with 23 years of investment experience. Jessica is a portfolio manager at Easterly Investment Partners for the Long Short Opportunity Fund, Large Cap and Equity Income Strategies, and Snow Capital Investment Partners. Plus, she's on the committee managing Snow Capital's Focus Value Strategy. She's going to be of great interest to viewers interested in fundamental investing and risk management. Prior to Snow Capital, Jessica began her career at Jennison Associates, where she was responsible for research coverage in the consumer discretionary and staple sectors of small and mid-cap portfolios. She's a top 6 finalist, Global Equities Leader of the Year, Women in Asset Management Awards, November 2022. Winner Best Liquid Alts Fund Equity Hedge from Hedge Week US Awards, October 2021. Top 3 in Large Cap Value Universe, Q1 21 Top Guns Model Portfolio, and Zephyr and Informa Financial Intelligence in 2021. Top 4 finalists out of 146 nominees in the U.S. Value Equities Women in Asset Management Awards, September 2019. And top female fund manager, Alts Funds 100 Women in Finance, August 2018. Jessica graduated from Georgetown University School of Foreign Service with a bachelor's degree in Foreign Service and received the IEP in Lyon, France. She holds the Chartered Financial Analyst designation and is a member of the CFA Institute and the CFA Society of Pittsburgh. She's a speaker for the Smart Woman Securities program at Carnegie Mellon University. And Jessica is a trustee of the Winchester Thurston School, where she chairs the finance committee and is treasurer. So welcome, Jessica, welcome. I feel really excited to pick your brain here, and I'm sure everyone's going to be thrilled to hear what you have to say. So thank you very much for taking the time out.
Thank you, Nadine. What a nice introduction. It's exciting to be here.
So before we get into investment ideas, because I know everyone's going to be interested in specific things, I really do want to step back and talk about your investment philosophy. So, what makes a target investment for you, Jessica? And, when you think about that, how does your philosophy differ from the typical value allocation?
Yeah, I think that's a great place to start, because value is a field that people haven't been looking at for quite some time. And so some of the people who are watching this video might be refreshing their memory in terms of where value investing sits within the overall universe. When I think of value investing, I think primarily of 2 strategies. One is quality value, really high quality companies. Maybe they don't have significant revenue growth, maybe low single digit, but they're very profitable. They throw up a lot of free cash flow. They pay a nice dividend, and investors are really interested in paying for that consistency. And so that tends to have a premium multiple. The second type of strategy that is most common in value investing is deep value. And the first thing I think of when I think of deep value is a bad balance sheet or a lot of debt. And these are companies that are not as consistent. Maybe they've had some struggles that come from structural issues within their industry. And deep value and quality value, you think, tend not to interact with each other, but what we see is that there actually is some interaction with investors, where quality value investors live in fear that one of their companies will become deep value, and deep value investors are hoping that one of their stocks will eventually become quality value. At Snow, we sit right adjacent to quality value, and we take advantage of the dynamic within the industry where investors get very worried that their high quality company is about to become deep value. And it creates a lot of volatility that you might see between the 2 sides of value. So, we sift through names that are struggling, that have very strong balance sheets, and we decide which companies are well on their way to deep value, and which companies might just be temporarily experiencing some inconsistency or issues that will quickly resolve. And it's our view that that provides a very attractive universe of stocks. So when we step back and we look at value as an investing strategy, there are a lot of personalities, and valuation is a big piece of that. So our perspective is we look at fundamentals, we look at valuation, but we also look at the behavioral dynamics within the investor population that creates opportunity.
Jessica, it's funny because you hear people talk about each of those things, deep value, regular value, but I've actually never had somebody describe that, call it that sliver of each of them that also could intersect, they could flip, right? Which is, I think, part of my next question, because obviously, I've read a little bit about your background that you use options. So maybe, given the volatility that you mentioned, which can happen in this universe that you're looking at, as well as in, call it, today's market. So maybe you're having a field day. But then secondarily, the fact that you're looking for longs and shorts in this universe, I think would be really interesting to folks who are listening.
Yeah. Our team at Snow evolved out of a family office a little over 20 years ago. And one thing that is unique about family office investing is that that type of investor is typically looking to preserve growth. They're not looking for absolute upside. In fact, they're fearful of volatility and they're trying to manage their risk. And so that dynamic is really very much a part of our DNA on our team. And while we do have long-only portfolios that we run, the majority of our legacy family office clients and many of our employees are invested in our hedged products, the largest of which is the Snow Long Short Opportunity Fund. This is a fund that was launched in 2006, and it's really designed to maximize our risk-adjusted return within our philosophy. And you can imagine that the types of companies that we're looking at have, in the very near term at least, a significant amount of volatility. That's what brings them into our universe. And that volatility breeds concern to the downside, and as a result creates option premiums that are exceptionally high. So one of the ways that we harness that volatility is by selling options on our long portfolio. So an individual stock that we might be looking at to add to the portfolio might be very attractive at its current price, but would be even more attractive if that stock were to go down 10 or 15%. And so when we're building a portfolio, typically we're looking to build a core position, and that could look like a 1% or a 1.5% position, and additionally sell a put on that company, on their stock that's down 10%, that gives us some premium. The benefit of that process is that it gives us some income, allows us to harness that volatility. It allows us to have a position size that grows as the stock goes lower. So it creates some discipline on the buy side. And it gives us some insight into essentially what sentiment looks like in a very numeric number. We can look at how concerned investors are that a stock might blow down 10 or 15%. Sure. There are times when option premiums aren't that attractive, and sometimes that means to us that the stock is near its bottom. So we use that option strategy integrated into our long portfolio in order to get the most out of each individual stock, but also to give us insight into where that stock is headed.
So Jessica, is there a certain implied volatility premium on the long side or implied volatility discount? I guess if you'd be selling, you'd be selling puts but selling calls on your different things. I'm assuming you might be selling calls on the things you don't like, but maybe you don't. But how do you think about measuring that where it gets attractive? You talked about one thing, which is maybe down 10, down 15%. But in terms of the price that you're getting, like that extra premium that you're getting for giving that option away, what do you look for? What are the metrics you're looking at?
Yeah, no, we are certainly looking for a specific return on each of those options that we sell, and it could vary. But there is something of a minimum. I think where it becomes more of an art than a science is when we kind of look at where the company is within their investing thesis and how close we are to the end of their fundamental issues. If we see a lot of fundamental issues ahead, we may be a little bit more disciplined in terms of where we sell that option, what the strike might be and what premium we require. And then, as you point out, similarly, as companies move through their investing thesis and as things work out for us and we get closer to the price target, we are very active in also selling calls. That's another important part of our short process where we will sell calls on an existing position. Once it gets over 2.5%, we'll look to sell calls if it's a possibility. And again, there we can generate some income while also forcing a sell discipline to reduce that position size as it moves higher. The other way that we use our calls is to become tax efficient. So there may be a position that we own for 11 months, for example, that is 20% away from its price target. And instead of selling the position, we will go out and sell a call that is beyond its long-term date, so that when we ultimately sell the stock, we will have a long-term gain on that position, and we'll also have the option income. So there's just a lot of optionality to the process, and it essentially allows us to get the most out of these stocks.
So I had other questions, but I'm so intrigued by this. So Jessica, do you guys play in certain sectors or certain geographies to be able to do the work, to be able to differentiate it? You're saying like which one's getting worse and which one's getting better, and people not knowing it yet, right? And figuring out what's the timeline for things to improve or worsen. Where are you fishing?
So we're looking at U.S. equities, and our team is a team of generalists that looks primarily really at all sectors and primarily on the large cap side within this product. So we're looking really above 5 billion, but we have some flexibility there. I would say that we are looking for a specific type of company that kind of cycles in and out of our orbit. So, while it seems like it's a very large universe, I think we are looking for companies that are experiencing near-term struggles, and they identify themselves very easily when we start doing our screens. And I think you can probably think about names that have fallen apart or fallen out of a portfolio and blow-ups. Those are obviously high on our list, but we're also looking at companies that have been lost and forgotten by most of the sell side. People are kind of at the lower end of their level of interest, and so we're kind of looking everywhere.
This is great. So looking ahead here to 2023, we're a few months in, and it's just as exciting as last year, but for maybe different reasons. So kind of staying on the big picture before we get to any names, why should investors allocate to value in 2023 after a pretty good run here in 2022?
Yeah, I mean, I think one of the areas that we look at as a team is just the interaction between reality and perception. And I think a lot of investors would like their clients to believe that 2022 was an exceptionally bad year that is confined to 2022, right? But I would say the first answer to your question is that many of the dynamics that caused value to outperform in 2022 continue to have momentum this year. The knock-on effects of interest rates normalizing are generally quite positive for the value style of investing, and that will continue to play out. Even if the Fed stops raising rates, there will continue to be an impact that rolls through the economy from higher interest rates. Similarly, commodity prices have a floor and will continue to have support in 2023, primarily because of China reopening, which I think is probably more back half loaded, but is going to be an important dynamic to this year. So I think the excuse or the explanation that energy has just had an exceptional year and now we're kind of going back to normal is problematic when you start looking at the supply demand dynamics in energy and other commodity price index. So I think that is certainly important. And then finally, when you have an anemic top line across the economy, when we're looking at 2 to 3% growth at the very most, people are going to be more focused on margins. They're going to be more focused on valuation. And I think that is certainly supportive of the value style. So I think that's very important to consider. The last thing I would say, Nadine, is that we're just starting to see how investor behavior has changed following what was, for the first time in a very long time, a tough year for growth investing. So I think the majority of investors who have a very high weighting to growth decided that they would just wait and see how 2023 played out and they wouldn't make any large changes. I think that might still be true for many of them. But I would just say that there could be some continued fallout from such a significant amount of underperformance from mega cap growth. And that could include allocations away from growth ultimately. So that's kind of to be determined, and we're going to wait and see there. But I think some of the catalysts to that change might include private equity marks and venture capital marks. As those start to come in, that might have a dampening effect on growth investing in the public markets. And that, again, could push people towards value.
When you say that, I just spent the last few days with a lot of people focused on those areas, venture and PE, and it's really clear that they have not fully marked their books down. And then the other piece and thing that resonated with me is, talking about obviously lower levels of growth, which is slower growth, and then, the drop into margins. And then as we think about it, that delta between margins and cash flow. And so if, you used to get, X% in cash flow from your EBITDA or your operating income, and now that's cut in half for whatever reason, I don't think investors are ready for that.
That's absolutely right. And when there is the zero interest rate, $1 today versus $1 tomorrow, you're somewhat indifferent. But as rates rise, you'd much rather have your dollar today. Yeah. And I think, again, that's problematic for DCFs and very positive for companies that are throwing off a lot of cash flow today.
Yeah. So is there a specific company or theme on the long side that you're finding attractive right now, or that you're looking ahead to say, gosh, we're working on that and planning it for that in the, next 6 to 12 months that you could talk about?
Yeah, so I think one of the things that's really interesting about my job and the philosophy that we practice is that, it's really out of my hands what sectors or what companies are coming into the universe. We just don't know, who's going to have a bad year, who's going to have a bad quarter. And so sometimes what you find is that all the companies get thrown out at the same time. So there've been years in the past where, we've had, so many options to buy, energy stocks and financials hand over fist, and we've been able to be very selective. And you haven't had any opportunity, for example, to buy industrials. And so I think what we're looking at in 2023 is, instead of having, thematic stories getting thrown out, instead of having entire sectors, we're starting to see a lot of individual companies have their own challenges or have more inconsistency. So it's creating a more diversified group of candidates for our portfolio, which is exciting because it makes our job a little bit easier when we already come in with a diversified number of sectors. But I would say that, we always have a lot of ideas within consumer, because that is an area of the market that just generally has a fair amount of volatility. There are a lot of names. There are a lot of ups and downs in those stocks. And that's always an area of success for us. We do have a lot of ideas in financials, and we continue to have ideas in energy. Healthcare has been an interesting field for us. I think there are some areas within healthcare that are very overpriced. But then again, there are some areas that are really interesting for a value investor like me. So I think there's just kind of a lot of interesting dynamics going on. There are still some sectors that show some outsized opportunities, but in general, it's a case-by-case basis.
Got it. And one of the things I like to learn from great investors is how they define risk. So I'm going to give you a two-part question, but first, letting us know, how do you define risk? But then, Jessica, how do you incorporate that risk management into your portfolio construction and security selection?
Yeah, I mean, I think risk at its very, very basic level is, what is our risk to the downside in terms of, an opportunity cost? Are we buying a stock that is going to be flat or down when the rest of the market has better opportunities? And I think, we look at that on a numeric basis in terms of the downside potential for our portfolio and for each individual name. And when we track a thesis, we really understand what the near-term risk might be for that stock, so that we can look, for example, to the options market and understand, what other investors might think risk is if we look at premiums on the downside with puts. And then, on the upside, we're always looking at what our opportunity costs are for continuing to own a stock over the long term, and if it's time to get out of something that might only have 10 or 15% upside. And so it's really a fluid process in terms of how we look at it. We do look at metrics to a certain degree. We look at beta to a small degree, but we also recognize that the type of investing that we do leads to exceptionally high short-term beta
Yeah.
for a stock. So we have to be very careful about worshiping the wrong god here, because what typically happens is that we buy a stock when their beta is high, and then as time goes on, that beta is coming in just by definition. And so we're aware of those typical risk metrics and factor metrics, but we're also cognizant that they're backward looking in nature. And so our challenge is really understanding the future, and that often is through the options market. So the way that we're managing risk is, one, through diversification and making sure that no position size is too large within the portfolio. Having a diverse group of long positions is key to that. Also using options to institute buy and sell discipline, so that, as we come in, if the market went down 10% tomorrow, our net exposure would rise because our puts would be in the money. And so that's a very interesting dynamic, and it actually is very healthy for us, because, as we know, we're all human. If the market went down tomorrow, I wouldn't feel like buying these stocks, to be very honest. And so selling is a good way to force me into a decision based on our fundamental approach. We've decided that this is the right place to buy a stock. And similarly, on the upside, being able to sell a call in kind of a neutral and objective way forces us out of stocks that are rallying, because, again, as investors, we know that you want to be careful not to worship the wrong god in terms of stocks going up and holding onto them for too long. That is its own risk in and of itself. So the sell discipline is really reinforced by our ability to sell calls.
I love that. Only two more things here, because I know we're almost out of time. One is, what is one of the greatest lessons learned in your career? You've obviously have learned a lot in 23, plus years professionally across different groups. What can you share with folks that you would say is something that was important to you?
One of the things that has really marked my career from even its early stages is the ability to see in the great investors with whom I've interacted their unending curiosity and their willingness to talk to anyone about investing. And I just feel so lucky to have interacted with some of the greats, and they are all, to a person, some of the most generous in terms of their willingness to share their knowledge and their perspective, and also their curiosity to encourage me to share my own views. And I think it's a reminder that some of our best ideas as a team can come from the most inexperienced person on the team, because they're creative, they're thoughtful, they have a different perspective, and that level of diversity only makes us better over time. And so I've really gravitated to those people who have that academic interest in investing, and also a willingness to talk about it and share it. And I think that to me is what really sets us all apart as we move forward together in this really interesting.
I think that's right. I mean, between the passion and then willingness to learn means willingness to accept mistakes or grow and do things differently, which isn't natural for a lot of people, especially as we all get older, right? Because you get set in your ways. So I think I understand your point and value that as well, of what makes this industry so dynamic, but what you can seek out for in colleagues or folks in your universe that you spend your time with, because that's such a valuable asset for you. And then last but not least, so Jessica, how can people find you, either to keep abreast of what you're doing professionally or just to get in touch? What's the best way for folks to contact you?
Well, you can certainly find me on LinkedIn. You can find me on Twitter. And you can also go to the Easterly website and look us up. We'd love to talk to anybody who's interested in our product. We've got a terrific team of salespeople and other colleagues at Easterly who are out there talking about our product. And our team here at Snow is really excited about the future. We have some terrific products, and we're also really excited for people to be more interested in value and value investing. So please reach out and let us know what we can do to help.
Fantastic. Thank you so much for giving us your time today, Jessica. And we hope to connect with you soon and hear how things are playing out in 2023 along the way.
I'd be happy to do that. Thank you.